You have $400 in your checking account. Your car just died in the driveway. The mechanic says it needs a new alternator, $750. You are $90 short of the repair. You have no savings account, and you need to be at work in 4 hours. In 1 week, that $750 repair is going to cost you somewhere between $1,500 and $2,500. And none of that extra cost has anything to do with the car. Okay, this is not a story about being unlucky. This is a story about how the financial system is built, how it works in the exact moment you are most vulnerable, and why the damage from one broken car can follow a person for 7 years. If you've ever had a month where one thing went wrong and everything else followed, this is the system underneath that. All right, let us start with the number that explains everything. 59% of Americans cannot cover a $1,000 emergency expense out of savings as of 2025. 59%, that is not a fringe group, that is most people. And for people earning under $50,000 per year, the number is even higher. The question people want to ask here is, why didn't they save? And the answer, once you actually run the math, is that there was nothing left to save. Take a household making $30,000 a year after taxes. That is $2,500 a month. Rent at $1,200. Car payment at $350. Insurance at $150. Utilities at $150. Groceries at $400. Phone at $60. Gas at $100. That is $2,410. $90 left over every month before anything unexpected happens. $90 does not build an emergency fund. It disappears into the friction of living. So when 58% of drivers say they cannot afford a car repair over $1,000, they are not confessing to a planning failure. They are describing arithmetic. The savings gap is not a character flaw. It is math working exactly as the budget allows it to work. So the car needs $750. The account has $400. What are the options? Option 1, a credit card if there is available credit, 22 to 24% APR. If you make minimum payments on $750, you will pay somewhere around $300 to $400 in interest before the balance clears. That is the cheapest option available. Option 2, a payday loan. You walk in, show a pay stub and a bank account, and they give you the money the same day. The fee is typically $15 per 100 borrowed. On $750, that is $112 in fees for a 2-week loan. Roll it over once because your next paycheck still came up short, and you have paid $225 in fees on a $750 loan. The APR on this product is 391%. That's crazy, right? The mechanic charged $750. The lender is on track to collect almost as much. Option 3, a car title loan. Same day money, 300% APR, and the loan is secured against the car itself. 1 in 5 car title loan borrowers loses the vehicle. You can borrow money to fix a car and then lose that car if you cannot repay. The median loan amount before repossession is between $1,000 and $2,000. The median car value repossessed is between $20,000 and $30,000. A $2,000 loan defaulted means the lender takes a $25,000 vehicle. Yeah, these are not aberrations. These are the products that exist specifically for people who need emergency cash today and cannot access mainstream credit. They are designed around speed and desperation, and they are the cheapest options available to someone with $400 and a broken car. While the car is in the shop, something else is happening to the bank account. The account has $400 in it. That is the buffer between the person and -0. Multiple transactions come in on the same day. A grocery run for $60, a gas station charge for $45, a phone bill auto payment for $60, and a utility auto payment for $85. That is $250 in total. The account can cover it, except many large banks. Until regulators force changes, process daily transactions from largest to smallest rather than in the order they arrived. The logic from the bank's perspective was that it was more important to cover larger bills first. The effect was different. In the order they actually arrived, all 4 transactions clear fine. Processed largest first, the utility clears at $85. Then the phone bill at $60, leaving $255. Then groceries at $60, leaving $195. Then gas at $45, leaving $150. No overdrafts. Now process them largest to smallest. Utility clears at $85, leaving $315. Grocery at $60, leaving $255. Gas at $45, leaving $210. Phone bill at $60, still fine actually in this particular example. But add one more charge that day, say the payday loan fee hitting at $112. Now the account drains past zero on the phone bill. That is a $35 fee. Then the payday fee hits and the account is already negative. Another $35 fee. 2 overdraft fees, $70 in charges for running out of money on the very day the borrowed money was supposed to help. A real case documented by CFPB research. A woman in Memphis had $800 in her checking account. Her rent auto payment of $800 cleared first, then 6 smaller transactions cleared afterward, each triggering a $35 overdraft fee. She paid $210 in overdraft fees on charges totaling less than $300. The bank covered those transactions. They just charged her $210 for the privilege. 9% of all U.S. bank accounts generated nearly 80% of all overdraft and NSF fee revenue in 2024. Banks collected $12.1 billion in overdraft fees that year. The accounts that generated 80% of that revenue were not random. They were the accounts living closest to zero. Now, the car has been in the shop for 2 days because a part had to be ordered. 2 days without a car means 2 missed shifts. For someone on a salary with PTO, this is an inconvenience. For an hourly worker in retail, service, or warehouse with no paid time off, 2 missed shifts is 2 days of wages gone permanently. At $15 per hour, 8 hours per shift, that is $240 that will never be in any paycheck. The repair bill just got bigger. All right, and the employment risk is real. Transportation is the second most common reason employers cite for losing entry-level workers. In at-will employment states, which covers most of the country, missing work because a car broke down is legal grounds for termination. There is no protection, no recourse. Show up or lose the job. The car is not a convenience. It is the infrastructure the job runs on. A moving opportunity study found that low-income families with cars were twice as likely to find a job and 4 times as likely to remain employed as those without. For most Americans outside of a handful of transit-rich cities, a car is not one transportation option among several. It is the only one. Suburbs and exurbs were built for cars starting in the 1940s and 50s through federal highway spending and suburban housing policy that made the car the default for everyone who could not afford to live in a city center. By the time lower income households moved to inner suburbs in the 1980s and 90s, those suburbs had no transit. The car was mandatory and there was no alternative. Day 3. The car is still in the shop. Rent is due in 4 days and the account is short. All right, the month's budget was already tight before the alternator. Now it is short by the amount of the payday loan plus the overdraft fees plus the lost wages. Rent comes up $150 short. The landlord charges a late fee, typically 5% of monthly rent or somewhere between $50 and $100. The utility company marks the account past due and adds a fee of $20 to $36. A credit card minimum payment is missed. Each of these fees is individually small, $50 here, $30 there, but they are not paid once and done. The utility late fee joins the next month's bill. The credit card minimum gets larger because the missed payment added interest. The late fee on rent is due with the next month's rent. Every downstream charge from that one broken car is still generating costs weeks after the car is fixed. Check this out. The car was repaired on day 4. It is back in the driveway. The physical emergency is over. The financial emergency is just hitting its stride. About 30 days after that missed credit card minimum payment, a notification arrives from the credit bureau. A 30-day late payment has been reported. A good credit score before this month might have been somewhere around 700. A single 30-day late payment drops that score by 50 to 120 points, depending on the scoring model and the rest of the credit history. That drop is not temporary. It stays on the credit report for 7 years, and it is not cosmetic. A lower credit score means higher interest rates on any future borrowing. It means higher car insurance premiums immediately. Poor credit increases full coverage auto insurance rates by an average of 98% compared to good credit. State Farm specifically charges customers with poor credit a 224% surcharge over their excellent credit customers. The car breakdown created a credit event. The credit event is now making the ongoing cost of owning and operating a car permanently more expensive. Okay, apartment applications use credit checks. Some employers check credit during hiring. The financial damage from one broken alternator in a single month will follow this person through rental applications, through insurance renewals, through loan applications for the next 7 years. The car is drivable again. The financial damage is still compounding. Let us add it up. $750 alternator repair, $112 in payday loan fees, assuming a single rollover would have doubled that to $225, but take the minimum, $112. $70 in overdraft fees, $240 in lost wages from 2 missed shifts, $75 late fee on rent, $30 utility late fee. That is $1,277 in total damage from a $750 repair. And that is before any credit score impact, before any insurance premium increase, before the compounding interest on a credit card balance being paid off on minimum payments. With the credit damage factored in, the multi-year cost of this one bad week is substantially higher. Higher insurance premiums for 7 years, higher interest rates on any future borrowing during that 7-year window. The $750 alternator, if it damaged a credit score enough to raise a car insurance premium by even $30 a month, is going to generate over $2,500 in extra insurance costs before the credit report clears. All right, a $900 repair can realistically become $2,500 in total damage. That is not the car. That is the system the car sits inside of. Overdraft protection as a fee product was invented in the 1990s. Before that, banks simply declined transactions you could not cover. The shift to automatic coverage and the $35 fee that came with it was a product decision. It was designed to generate revenue from low balance accounts. By 2009, banks were generating approximately $38.5 billion annually in overdraft revenue. The CFPB was partially created in direct response to these practices. In December of 2024, the CFPB issued a rule capping overdraft fees at $5 for large banks. The projection was that this rule would save 23 million American households an average of $225 per year, $5 billion annually returned to the people paying it. Congress overturned that rule in May of 2025. The payday lending industry was also not inevitable. It grew from roughly 200 stores in 1992 to over 20,000 stores by 2002. It was built legally on the foundation of a 1978 Supreme Court ruling that allowed national banks to charge whatever interest rate their home state permitted, regardless of where the borrower lived. Banks relocated to Delaware and South Dakota, which had eliminated their usury caps. Within a decade, 391% APR was a legal product in most of the country. Yeah, the system that extracts money from people during a broken car emergency was not an accident of the market. It was built deliberately through specific product decisions and specific legal changes over the course of about 40 years. And it is designed around the repeat borrower, not the one-time emergency. 75% of all payday loan fees come from borrowers with more than 10 loans per year. The product is not a lifeline. It is a subscription. A credit score does not measure how hard you work. It measures how much slack you had when something went wrong. The car repair is the trigger. The system is the damage. And the system does not care how responsible you are. It charges the same $35 overdraft fee to a person who has never missed a payment in their life. It applies the same 391% APR to someone who borrowed once and someone who borrows every 2 weeks. The fee structures are not calibrated to behavior. They're calibrated to desperation. And the single most useful thing you can take from this is understanding what the cascade looks like before it starts. An emergency fund that covers even 1 month of expenses does not need to be large to break the chain. $300 sitting outside the checking account means the overdraft fees never hit. Getting even partial repair financing through a credit union rather than a payday lender cuts the cost in half. Opting out of debit card overdraft coverage means the bank declines the transaction instead of charging you $35 for covering it. None of those are radical ideas. They are just interruptions at different points in the cascade. The cascade is the machine. Knowing how the machine works is the first step to not being inside it when something breaks. If this is the system you are already inside, or the one you want to stay outside of, subscribe. This channel covers the financial systems that shape ordinary life, and there is a lot more to show you.